Hey guys, Mike here. So it looks like the market wanted to pump us green into CPI day tomorrow, and that's really what this whole week's going to be about. And we're going to go into CPI expectations, how the market's actually responded after CPI reports over the last few reports, which may surprise you a little bit. Earnings, a couple charts as well, because there was an announcement for one stock which turned it green, which we didn't expect. But again, as you'll see, I think for the rest of the year, bad news for the economy is good news for the stock market. That's kind of the cycle we're in right now. But I did want to clarify something yesterday. I did a video yesterday, and I wasn't trying to talk about the complete cycle or anything, but I was trying to show you and illustrate it that people are there saying, oh, when unemployment's so high and things are just terrible, the stock market won't have great returns. Well, the stock market tends to perform and have some of the greatest returns ever when you see double-digit unemployment and when people are sitting in soup lines and everything else, and it just looks horrible. Okay, just think back about 2009. But I will clarify something because I don't want to cause any confusion here. And because I read all the comments, so I saw people in the comments say, well, I noticed on the charts that when the unemployment starts dipping and then starts spiking, the stock market crashes and then spikes then, right? It's like a delay, right? And so again, I'm not gonna go through this whole cycle because I could do a 2-hour video on this, but just to clarify what you see here, this obviously is a chart I presented to you yesterday. Hopefully you saw it. If not, it'll be at the end of the video. That is the S&P. The blue one is the unemployment. These shaded areas right here, that is recessions, okay? And that's why you're seeing what happens is the market tanks because things are really freaking bad. And then the economy starts to, the unemployment rate, starts to go up. But what we're missing in all this is the Fed's fund rate, right? And this is what the market keeps, we're going to have cuts, we're going to have cuts. The reason why they're saying we're going to have cuts is because they're expecting a recession, right? The Fed should not cut unless there is a recession. They've only done, I think, in 2018 is when they actually did, or 2019, excuse me. And so when you see right here, anytime you see a recession, what do you see? The Fed funds rate gets cut, right? Because that means things are really bad. We're getting a lot of slow growth, things like that, and they're trying to stimulate the economy. And so that's why you're seeing that dip in the stock market, right? And so if you see the Fed cut, what should happen is the stocks should go down. That's what's happened historically time and time again. And basically what's happening is the Fed comes to the rescue and starts turning on the printer. We go to zero interest rates usually. They'll start sending out stimulus, buying bonds, mortgage-backed securities, and all that fun stuff. And so hopefully that makes a little more sense now. And understand those little boxes aren't going to appear as far as the shaded areas because we're not going to officially know we're in a recession until like a year and a half later when the government actually announces it, okay? So just understand that you may be able to feel like we're in a recession, like people thought we were in a recession last year and stuff like that, but that's, you're not going to know that, right? And so a sign to know if we're actually in a recession is the Fed cutting? Yes, right. That's historically almost every time they start cutting when things get really bad and they need to stimulate the economy, right? And so the other thing to look at, which this reminds me of, is I know Janet Yellen came out the other day and she said, hey, you can't have a recession with record unemployment. I've been guilty of that myself, but I can admit when I'm wrong with something. And so I'm going to show this to you because it isn't true. We've had a few occurrences that this has actually happened where we had a recession with really low unemployment. And if you just go up here to the unemployment rate, look right here. We were sitting at 3.8, had a recession, right? I'm going to just go back and just lead forward. Look at this one. 2.5% unemployment, which is crazy. Had a recession. All right. You come forward up here, anything over 4, I'm not even going to look at. I'm just going to say anything under 4 to me is historic, right? 3.5, boom, had a recession, right? And so these are a little higher, so I'm not going to count them. And then go down here, 3.9, had a recession in 2000, right? I think 2008 and then was actually too high, so I'm not going to count that one. And you can count, look in 2020, we were actually sitting there at 3.5% unemployment, supposedly. So, still we shut down the world. And so it can definitely happen. Just in this instance, the difference is to me, and again, I wasn't born in the 50s and 60s and stuff, and let me know if I'm wrong on this, but I don't think we had a worker shortage. I just don't think we did, right? What we're going through now, this worker shortage, and people still can't get the job, people, working their businesses, and there's so many open jobs out there. Is still just insane, and people actually can literally go five jobs to work right now if they wanted to. I've never seen it before. Again, how long is it going to take to work out and play out if they can't slow the economy enough? I have no idea, right? But right now, they're not even coming close to really slowing down the economy. My God, I just got to go buy Valentine's Day stuff for my son in his class. I could barely move in the Walmarts and the pub. I had to go to 4 or 5 different places to find it, and the shelves are completely wrapped empty. Places are packed out, and I'm going, it's 2 o'clock in the afternoon. Like, what the heck? But it's just nuts to me. I'm like, okay, great. And so that leads me into something else, and then I'm going to get into the charts and stuff, and it still blows my mind of how much these buybacks are going up. Look at this. This is the first quarter of 2023. It is February, 13th right now. They've already eclipsed the last 2 quarters of stock buyback announcements already. And we still got another month and a half to go here. And when you look, if you notice, Q1 is usually pretty high. We're obviously going to beat it. I mean, Q1 2019 was insane. I think we're definitely going to beat that. But what's crazy is look what, if you look, that's about the top right there, the average of Q1. So we should definitely beat that. But look at the quarter that has the biggest amount of stock buyback announcements. That's the next quarter. Second quarter is just insane. Look at those second quarters. 3 out of the last 4 have just been unbelievable amount of stock buybacks going on. And so, this is going to be, obviously a record year. Unless something happens, it's going to be an absolute record year for sure. Well, what's crazy to me is, can you imagine, like right now what's happening? Layoffs, right? And the stocks are being rewarded. They're going, hey, good job, you laid people off. And the stocks go up, right? But can you imagine, like, being one of those people, and I've been laid off before, I don't know if you have, and you get called in, they always say, it's not you, it's us, the whole breakup relationship thing, And then they're like, we got to cut costs, we got to save here, save there. And then, like, you're sitting at home looking at this, and you're seeing the company laid you off to, like, cutting costs, taking that money they saved on you, and buying back the stock. It's like, because it's an obscene amount, right? They're spending at this point in time. You got companies that have no business trying to buy back stock right now. They know what the game is. Layoffs, stock buybacks. That's the way it is. And it's probably going to continue to be that way for the rest of the year, right? And that leads us into, what did Meta do today? They came out this morning, popped 2% in pre-market, because they're getting ready supposedly for another round of layoffs because they've delayed finalizing the multi-team budgets in preparation for a fresh round of job cuts supposedly. And of course the market goes, hey, that's fantastic. Boom, it gaps up in the morning. It tries to break out of that gap that it left. So now we have a gap within a gap now, of course. That's going to be interesting to see how that plays out. But of course it stays in this gap right here. It sells off. It's not able to break out yet. And like I told you the other day, I expected a basically short-term pop because what was going on, we were over sold right there, right? And so we got the pop all right. I just didn't know they were going to be announcing probably a second round of layoffs if that's going to be the case this soon, because they laid off a whole bunch of the workforce before. And then if we look at the bigger time frame, obviously they're about to be going right back into overbought again. So, and of course a lot of this is going to depend on CBI. No ifs, ands, or buts about that. And then that leads us into Tesla. And Tesla, of course, was kind of the opposite, right? It ends up gapping down, fills the gap perfectly right there. And then what's to do? Just trade sideways perfectly, just bouncing off the anchor and VWAP all the way across. Just coiling up, hanging out, ended up slightly red for the day. But again, with that big move up. And what I want to see is it going to test this trend line right here, right? It's bounced off of multiple times. And that'll also correlate with about the 180 area, because that 180 to 200 area is a big area for this stock. And it seems to be doing just fine hanging out in there. And this is what I was talking about with retail investors who buy into this. They usually do not sell. And so we're going to get to see, if that MACD actually finally rolls over and Tesla actually does get a break. And then leading into Apple, one reason you had the market green today, remember this makes up a huge part of the S&P. And what happened? It broke out today, right? And like I told the members last night, people are still buying at these prices. They still love Apple, still love the iPhone and everything else. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. And like I said, all you got to do is watch Apple and now add Microsoft to that, because it's a $2 trillion company too, right? And so they're making up over 10% of the S&P, probably almost 18 to 20% of the Qs by themselves. And so as long as those two stocks hold up, you can forget about any major drops, right? And so now if we get a hot CPI report, which we're going to get into, maybe, who knows, maybe if the narrative changes. But as far as those two companies, big money is holding them up big time, and so are their stock buybacks, right? And so getting into earnings tomorrow, you're going to have a bunch actually. So you can be sitting here with Coca-Cola, Cleveland Cliffs, Peabody, Marriott, Devon Energy, Airbnb, Upstart, Going to have TripAdvisor is another one to watch out. Suncor is another energy company to watch out for. And the three I'm paying the most attention to is going to be Marriott, Airbnb, and TripAdvisor, because if we're traveling, we're definitely doing everything else. That is for sure. And then looking at the economic stuff, it's going to be a loaded day tomorrow with speakers and CPI, right? We already had the speaker today. Again, the market ain't listening to those folks. That's just the way it is. They can come out there and speak all they want, but it's all about the CPI. And there will be a small business index, but I don't think anybody's going to care about that. And when you look at the last daily performances after the CPI report was released, if you look at November, it was a huge day right there. But you look at December, 0.76, nothing to write home about. January, 0.36. We'll see how tomorrow works out. And tomorrow is going to be one of the most interesting ones because obviously you got new weights now, right? New weighted measures. So now housing is going to be, and shelter is going to count more against CPI. Like used cars, for example, count less. And so that's something to think about as well. And then you have the new year over year, which I don't really care about, but that's the new calculation. We're comparing it to 2021 versus the average of 2019 and 2020. And I find it interesting that, you know, what's Jerome Powell do? I think 11 times in the last speech he gave that use disinflation or deflation, and the market just loves it. That's what they want to hear, right? That's all. They don't really care about the number itself. They just care, are we heading down? That's all they care about, right? There will come a point in time where we do hit a sticking point because, like they said, all of them said it, services inflation ain't coming down, right? And it may be a long time for that. And so that's what we got to think about, right? And so, you know, and especially, again, with the employment issue we have as far as there's just so many jobs out there and not enough people to fill it, people will still be able to get higher wages, right? And so that's something else we got to see how long it's going to take to play that out, because what they're doing right now ain't slowing down the economy at all in my eyes. Let me know in the comments what you think. I know certain areas are being hit harder than others. Probably industrial areas is what I would think. But, you know, just food for thought. So let me know in the comments what you think. Hit the like, subscribe if you get anything out of it. And I'll see you tomorrow.